Welcome to Hybrid Market Terminal podcast, where macro meets momentum and strategy drives every move. Today, we're doing a deep dive into something I think a lot of us are searching for. A bit of calm in the market chaos. We're going beyond the usual noise, the volatility talk.
Right. We're exploring a really practical roadmap for building steady, reliable income. It's all drawn from Michael J. Carter's book, Safe Dividend Investing 2025, a great guide.
And the core idea, the mission here, is pretty compelling. Carter says, look, chasing those massive stock price jumps, it's stressful.
Super stressful, and maybe, just maybe, not even the best way to get where you want to go financially. He argues the focus should shift completely.
To what exactly?
To creating an income stream, one that's reliable, consistent, something that doesn't keep you up at night.
That promise really resonates, doesn't it? Especially if you feel swamped by all the conflicting advice out there. Carter's basically saying investing doesn't have to give you heart attacks.
Exactly. It should be like turning on a tap. Consistent income, just flowing steadily. Doesn't matter if the market's having a meltdown or a rally.
And what I liked reading through it is the clarity. He avoids the jargon,
He really does. He used to be in corporate finance, so he knows the complex stuff. But he breaks down things like dividend yield, payout ratios, free cash flow, makes them digestible, actionable.
No long, boring theories, just a clear plan.
A very clear plan.
Okay, so for this deep dive, here's the plan. We'll start with the mindset shift, becoming that calm investor. Then we'll get into the nuts and bolts, what makes a dividend actually safe.
And that includes his 5-point safety scorecard. We'll spend a good chunk of time there. It's crucial.
Definitely. We also need to talk about those tempting high-yield traps, how to spot them, how to avoid them.
Oh, yeah, very important.
And finally, the practical stuff. Building the portfolio, making that income grow through compounding, and being smart about taxes.
Sounds like a solid roadmap. So where do we start?
Yeah.
Mindset, right?
Let's do it. Chapter 1 hits it head on. The emotional roller coaster. It's not usually about being smart, is it? It's about keeping your cool.
Absolutely. Carter calls them sneaky little gremlins, hijacking your decisions. And the first one, big one, fear of loss.
That feeling that makes you check your portfolio, 10 times a day?
Or more. And then you see a little dip, and bam, you sell. Rash move. Even if nothing fundamental about the company changed, it's just the pain of seeing red.
Then there's the flip side, greed.
Greed is what makes you chase those crazy stories, right?
Mm-hmm.
Some tiny stock goes up 500% in a week, and you think,
Why not me?
exactly.
Yeah.
So you ditch your sensible plan and gamble on some long shot. Usually doesn't end well.
And the third gremlin, maybe the toughest one today, is comparison.
Oh, for sure. Social media is brutal for this. You only see the wins, right? Your friend who bought crypto early.
Right.
The coworker who made a killing on a meme stock.
Yeah, it makes you feel like you're falling behind, that everyone else is getting rich faster. It just destroys your focus.
So Carter's Calm Investor framework is all about shifting gears, moving from reacting emotionally to responding intentionally.
And the first step he emphasizes is know your why.
Absolutely critical. You have to define your goals clearly. Is it retirement income? Paying for college? Building an emergency fund? What is it specifically?
Because that goal acts like your anchor, right? Your compass.
Precisely. If your goal is, say, 20 years away, then a bad week in the market, it's just noise. It's not a 5-alarm fire threatening your actual goal. Without that why, every headline feels like an emergency.
Makes sense.
So,
Okay, what's next in the framework?
Embrace simplicity. This is huge. His mantra is calm beats clever.
I like that.
Yeah. Most people, retail investors, they don't need super complex strategies.
Right.
Forget day trading, forget fancy options.
So what then?
Focus. Focus on a handful of really solid quality companies. Learn the basics. We'll talk about yield, payout ratio. Keep the portfolio simple. Fewer decisions mean fewer chances for anxiety to creep in.
And the third part of the framework?
Establish routine. This is your active defense against that obsessive checking we talked about.
Right. Don't watch the ticker all day.
No. Set a schedule. Maybe you check things, once a quarter. First Monday, say. Review things then. Be informed. But don't get sucked into the daily drama.
So the whole point is to transform that anxiety. He asks you, the listener, to think. When did money last make you anxious? Was it real risk or just market noise because you didn't have clear goals?
Exactly. Take that nervous energy and channel it. Turn it into informed, calm action.
Okay, informed action needs tools. Let's get into Chapter 2, the basics. Dividends. If we're building an income portfolio, what are we actually collecting here?
Okay, simplest terms. A dividend is just a piece of the company's profits.
A slice of the pie.
A slice of the pie, yeah. The company's board decides to share it with the owners, the shareholders, usually paid out in cash, typically every quarter.
But why do some companies do it and others don't? You look at Amazon, Google, they reinvest everything. But Coca-Cola, Johnson & Johnson, they pay. Why?
Good question. There are a few key reasons. One, it attracts a certain kind of investor, someone loyal, focused on income, not just hoping the stock price moves.
Okay, stable investor.
Stable investors. Two, it signals strength. It's the company saying, hey, we're making so much cash, we can fund our growth and give some back to you, the owners. It actually imposes financial discipline on the managers.
Interesting.
And three, well, it's a reward. It's part of your total return, especially important when the stock price itself isn't going anywhere fast.
Got it. So if we're looking for these, what are the absolute must-know metrics? Carter highlights two.
Two key tools for gauging safety: dividend yield and payout ratio. Non-negotiable.
Let's break down yield first.
Dividend yield is pretty simple on the surface. It's the annual dividend payment divided by the current stock price. So, a $100 stock paying $4 a year, that's a 4% yield.
Okay, seems straightforward. But Carter warns about this one.
Big time. A really high yield, say 10% or 15%, that's usually not a good sign. It's the classic red flag.
What? Isn't more income better?
Not if it's high because the stock price has crashed. That usually means the company's in trouble and a dividend cut might be coming. It's the definition of a dividend trap.
Ah, okay. So the yield number alone isn't enough. That's where the payout ratio comes in.
Exactly. The payout ratio is the safety check. It tells you what percentage of the company's earnings are being paid out as dividends. If a company earns $10 per share and pays out $4 in dividends, the ratio is 40%.
And what's a safe level?
The rule of thumb, and Carter really hammers this home, is somewhere around 50%, maybe up to 60%. That leaves the company plenty of room, room to reinvest, handle surprises, maybe even raise the dividend later.
And if it gets too high, like 90%?
Danger zone. Very risky. A slight dip in earnings, and they might have to cut the dividend. It's not sustainable.
Now, you mentioned a nuance here earlier about how this ratio is calculated. It's not just about net income.
Right, this is crucial for really understanding safety. Net income can be misleading. It includes non-cash stuff like depreciation, or it can be skewed by one-off gains or losses. Dividends have to be paid with actual cash.
So you need to look at
Free cash flow, FCF. That's the cash the company generates after paying for its operations and investing in its future, like building factories or buying equipment. That's the real pool of money available for dividends.
And the payout ratio should be calculated against that number.
Ideally, yes. You want to see the dividend payout being, say, less than 60% of the free cash flow. If the dividend is eating up almost all the free cash flow or more, that's a serious warning sign, even if the net income payout ratio looks okay.
That FCF distinction feels really important for digging deeper. Okay, let's make this real. Examples. Coca-Cola, KO, classic dividend stock.
Textbook example of reliability. They've paid dividends for ages and consistently increased them for over 60 years straight.
60 years.
Yeah. And the power isn't just the payment, it's the growth. If you bought KO shares 10 years ago, maybe your yield based on your purchase price was 3%. But because they kept raising the payout year after year.
Their income stream grew.
Exactly. Your yield on your original costs might be 5% or 6% today. That rising income, that's the engine Carter talks about. Passive wealth building.
Another one he mentions is Johnson & Johnson, J&J, a dividend aristocrat.
Right. Over 50 years of consecutive dividend increases. J&J is a great example of internal diversification, too.
How so?
They have three big, pretty resilient segments: pharma, medical devices, and consumer health. If one area has a tough year, the others often pick up the slack, keeping the overall cash flow stable enough to support that dividend. Plus, their global reach gives them a strong competitive edge, an economic moat we'll touch on later.
Okay, these are big, established companies. What if you're just starting out, feeling maybe a bit overwhelmed picking individual stocks?
Carter has a good solution. Dividend ETFs.
Uh-huh.
Exchange-traded funds.
So how do those help?
They make diversification easy. An ETF bundles together maybe 50 or 100 different dividend-paying stocks into one single investment you can buy.
Ah, so you're not putting all your eggs in one basket.
Precisely. It spreads your risk across many companies, many sectors. Plus, ETFs usually have pretty low fees, which helps your long-term returns. For a beginner, or anyone wanting simplicity, they're often a fantastic starting point.
Okay, that makes sense. We understand dividends, yield, payout ratios, FCF. We've seen examples. Now, how do we actively find these safe stocks today? This brings us to the core of Carter's method, right? The filter.
Yes, the 5-point safety scorecard. This is chapter 3, and it's really the engine of the whole strategy. It's how you move from theory to actually picking stocks reliably.
Taking the guesswork out.
Exactly. Filtering out the noise, focusing on what genuinely indicates safety and reliability.
All right, point 1 on the scorecard.
Dividend history. We touched on this, but it's crucial. You're not just looking for any dividend, you want consistency. Has the company paid it for at least a decade? Ideally, have they increased it over time?
Past behavior predicts future behavior, sort of.
In finance, it's often the best predictor you have, especially through different economic cycles. A long history shows commitment and resilience.
Okay, history checked. Point 2.
Back to the payout ratio. We need to check that number against recent earnings and, more importantly, against free cash flow. Aim for under 60%.
That breathing room again.
Gotta have the breathing room. Lets them reinvest, handle emergencies, and keep paying you even if things get bumpy. Over 75% consistently. Red flag waving.
Makes sense. Point 3, this goes deeper.
Financial health. This is where you look under the hood. Check the debt levels. A common measure is the debt-to-equity ratio. Generally under 1.0 is considered pretty healthy. Means they rely more on owner's equity than borrowed money.
But you said free cash flow is the gold standard here, too.
Absolutely. For the calm investor, FCF is king. Forget the accounting profits for a second. Is the company generating enough actual cash to easily cover its dividend payment? You want to see FCF covering dividends by maybe 1.5 times or more, ideally. If FCF is weak, volatile, or negative, that dividend's living on borrowed time.
Okay, I have to jump in here. If we're so focused on history, low payout ratio, strong financials, aren't we automatically ruling out exciting growth stocks, companies that might deliver huge returns later? Isn't there an opportunity cost?
That's a fair question, and Carter addresses it directly. It comes back to your why. The calm investor's goal isn't necessarily to find the next Tesla before anyone else. The goal is predictable, rising income.
So it's a trade-off.
It's a conscious trade-off. You might sacrifice some explosive upside potential for a much higher probability of steady, reliable, growing cash flow that compounds over decades. Remember, calm beats clever. You're choosing peace of mind and predictable results over speculative stress.
Understood. Okay, point 4 on the scorecard.
Market position and stability. This is less about numbers, more about the business itself. Does it have a strong competitive advantage? Warren Buffett calls it an economic moat.
What protects it from competitors?
Right. For Coke, it's that globally recognized brand and massive distribution network. For J&J, maybe it's drug patents. For a utility company, it could be regulatory protection and near monopoly. You want a business that's hard to disrupt, ensuring those revenues keep flowing.
And the final check? Point 5.
External factors. You got to lift your head up and look around. What's happening in the industry and the broader economy? Are there potential regulations coming that could hurt profits? Think like environmental rules hitting energy companies.
Or geopolitical risks, shifting consumer tastes.
Exactly. Is their main product becoming obsolete? This step makes sure a company isn't just healthy today, but also resilient to predictable future shocks.
Wow, okay, that's a thorough checklist. But it doesn't have to be overwhelming, right? You mentioned tools.
Yeah, thankfully you don't need a Bloomberg terminal. Free websites like FinViz, Yahoo Finance, MarketWatch have stock screeners. You can literally plug in criteria like yield between 3-6%, payout ratio under 60%, debt to equity under 1.0.
And it filters thousands of stocks down to a manageable list.
Instantly. Turns hours of digging into minutes of focused analysis.
And Carter suggests a practical exercise to start.
Yeah, pick your first 3. Don't agonize over finding the perfect stock. Just pick 3 brands, maybe Starbucks, P&G, your local utility, and run them through the scorecard. Check their history, payout ratio, FCF, moat. It makes the process concrete, less intimidating, builds confidence.
Okay, so we have the tools to find the good ones. Now we need the tools to avoid the bad ones. Chapter 4, the trap detector. That warning about high yields.
Yes, the red flag waving in the wind. Yeah. That super high yield is almost always fool's gold. It's a sign the market thinks the dividend's about to get cut, hence the falling stock price.
Chasing it turns your income plan into a stress machine.
Totally. Let's look at the big example Carter uses. General Electric, GE.
A blue chip icon for decades. What went wrong viewed through the scorecard?
Well, hindsight is 20/20, but the warning signs were there before the big cut in 2018. Dividend history. Looked okay, but financial health. Point 3 was flashing red.
How so?
Debt was piling up, the debt-to-equity ratio was getting scary, and crucially, their free cash flow wasn't comfortably covering the dividend anymore. It was masked by complex accounting for a while, but the underlying cash generation was weakening.
So when things got tough,
The stock price plunged, the yield artificially spiked, and management had no choice. They slashed the dividend by 92%. The fundamentals failed the scorecard test long before the cut actually happened.
a painful lesson. History isn't enough if the current financials are deteriorating. What about Ford?
Ford suspended its dividend entirely in 2020 during the pandemic. That highlights a different risk external shocks hitting cyclical businesses.
Companies sensitive to the economy.
Right. Car makers need huge amounts of capital, often carry debt. When the economy shut down, their cash flow dried up fast. They didn't have enough reserves to keep paying shareholders and survive the crisis. The dividend had to go.
And those specialized structures, energy transfer LPs, some REITs, they often show tempting yields.
Yeah, you had to be extra careful there. Energy Transfer and MLP had huge yields, but was also carrying massive debt. When energy prices weakened, boom, dividend cut.
And high-yield REITs, like mortgage rates.
Very sensitive to interest rates. Their model often involves borrowing short-term to buy longer-term mortgage assets. When short-term rates shot up recently, their borrowing costs exploded, crushing their profit margins and forcing dividend cuts across the board. The high yield wasn't free money. It was compensation for taking on significant interest rate risk. It failed. Point 5, external factors.
So the core message is, ignore the siren song of high yields, focus on that sustainable payout ratio under 60% of free cash flow.
Let consistency be your guide, not greed. Quiet, dependable income beats lottery-like yields that disappear.
Okay, we know what to look for, what to avoid. Now let's talk about actually building the portfolio. Chapter 5. Carter breaks it down by budget size, which is helpful.
Yeah, it makes it accessible. For the starter portfolio, say $1,000 to $5,000, the absolute focus has to be on quality.
Don't spread yourself too thin.
Exactly. Buy one or two top-tier blue chips that smash the scorecard, tests your Cokes, your J&Js. Or, even easier, start with a diversified dividend ETF. And the most important thing at this stage,
Reinvest those dividends.
absolutely, turn on the DRP dividend reinvestment plan. Make it automatic.
Okay, moving up. Intermediate portfolio, maybe $5,000 to $20,000. What changes?
Now you have enough capital to really start diversifying properly. Spread investments across different sectors, maybe add some energy, some stable tech, healthcare. And this is where Carter says you should definitely consider REITs.
Real estate investment trusts. Why are they key here?
Two big reasons. One, they're legally obligated to pay out most of their taxable income, usually 90% as dividends, so high income stream built in. Two, they give you exposure to real estate profits without being a landlord, and that income can often help offset inflation over time.
Got it. Income boost and diversification. Now the advanced portfolio, $20,000 plus. What opens up?
Here you can get a bit more sophisticated with managing the timing of your income. Explore a laddered dividend strategy.
Laddered. How does that work?
You intentionally select quality stocks that pay their dividends in different months. So Company A pays in January, April, July, October. Company B pays in February, May, August, November. Company C pays March, June, September, December.
Ah, so you engineer a steady paycheck every month instead of getting lump sums quarterly.
Exactly.
Yeah.
Smoothed out the cash flow, which can be really helpful for budgeting or living expenses. You can also start looking at reliable international dividend payers for more diversification, if that fits your plan.
Carter pulls this together into what he calls the power trio for portfolio construction.
Yeah, a simple but effective framework. Blue chips, ETFs, and REITs. For someone starting out, he suggests a rough allocation, maybe 40–60% in solid blue chips for that core stability.
Okay.
Then 20–40% in dividend ETFs for broad diversification and maybe a bit more growth potential.
And the rest?
And 10–20% in quality REITs for that income kicker and inflation hedge. It's a balanced starting point.
Balanced, diversified, income-focused. Makes sense. But the real magic, the thing that turns small amounts into large amounts over time, that's chapter 6, right?
Oh, yeah. The power of compounding.
Yeah.
Especially through those drips we mentioned. This is where patience truly pays off.
Explain the snowball effect ago.
It's simple but profound. Your dividends get paid. Instead of taking the cash, the drip automatically uses that money to buy more shares of the same stock, even tiny fractional shares.
So your next dividend payment is slightly bigger because you own more shares.
Precisely. And that slightly bigger dividend buys even more shares, which generates an even bigger dividend next time. It's returns, earning returns on themselves on a constantly growing base. The snowball rolling downhill, getting bigger and bigger without you actively pushing it.
Carter gives a pretty stunning example, doesn't he?
He does. He shows how an initial $5,000 investment, if you pick a solid stock yielding 4%, Assume the dividend grows at a modest 5% per year, and you reinvest everything.
For how long?
Over 30 years, that initial $5,000, just through the power of reinvested dividends compounding, can grow to around $150,000.
Wow. $5,000 to $150,000 just from the dividends working for you.
Just from the dividends reinvested patiently. And importantly, that calculation often doesn't even include any increase in the original stock price itself. So the total value could be significantly higher.
That really drives home the point. It's not about market timing or finding unicorns. It's consistency, reinvestment, and time.
That's the engine. Consistent cash flow, automatically reinvested, given decades to work its magic. That's the calm investor's path to wealth.
Okay, so this income stream starts growing, becoming substantial. We need to be smart about keeping it. Chapter 7. Taxes.
Can't ignore the tax man. First big lesson.
Right.
Know the difference between qualified and ordinary dividends. It's huge.
How huge?
Ordinary dividends get taxed at your regular income tax rate. Could be 24%, 32%, even 37% federally, plus state taxes. But qualified dividends, typically from U.S. companies or approved foreign ones, and you have to hold the stock for a certain period.
Those get taxed at the lower long-term capital gains rates.
Exactly,
Yeah.
which are 0%, 15%, or 20% depending on your overall income. That difference, 15% as 37% say, adds up to thousands saved over the years. Just knowing this distinction is step one.
And where you hold these investments matters too, right? Tax-advantaged accounts.
Absolutely essential for maximizing compounding. Carter strongly recommends using accounts like a Roth IRA. You contribute money you've already paid taxes on.
But then the growth and withdrawals in retirement are completely tax-free.
Completely tax-free. All that compounding happens sheltered from taxes. A traditional IRA or 401k gives you a tax break now, but withdrawals are taxed later. Roth is often better for long-term dividend growth.
And you mentioned another account, the HSA.
The health savings account. If you have a qualifying high-deductible health plan, this is like the superhero of investment accounts. It has a triple tax advantage.
Triple?
Yep. Contributions are tax-deductible going in. The money grows tax-free inside the account. And withdrawals are tax-free if used for qualified medical expenses.
Okay, but for retirement investing.
Here's the kicker. Once you hit 65, you can take money out for any reason, not just medical. You'll pay ordinary income tax on non-medical withdrawals then, just like a traditional IRA. But you still got the upfront deduction and decades of tax-free growth. Many experts consider it the single best long-term investment vehicle if you qualify.
Good to know. Beyond account types, any other strategies? Tax loss harvesting.
Yeah, that can be useful. If you have some investments that have lost value, you can sell them to realize the loss. That loss can offset capital gains you have elsewhere, potentially wiping out the tax bill on those gains.
And if you have more losses than gains?
You could use up to $3,000 of those losses to reduce your ordinary taxable income each year. Any leftover loss carries forward. But big warning, you have to watch out for the wash sale rule.
Right. Can't sell for a loss and immediately buy it back.
Or buy something substantially identical within 30 days before or after the sale. If you violate the rule, the IRS disallows the loss deduction for that year. So you need to be careful with timing if you plan to harvest losses.
And one last tax point, holding periods.
2 key ones. For dividends to be qualified and get the lower tax rate, you generally need to hold the stock for more than 60 days during the 121-day period that starts 60 days before the ex-dividend date.
Bit technical, but important.
And for selling the stock itself, remember you need to hold it for more than 1 year to get the lower long-term capital gains rate on any appreciation. Selling before a year means short-term gains, taxed like ordinary income. Patience helps your tax bill too.
Okay, brings us full circle. Theory, tools, portfolio structure, taxes. Now, putting it all together, Chapter 8, the 12-month calm income plan, the blueprint.
Right. This makes it actionable step by step. Step 1, set clear income goals. Not just vague, safe retirement, get specific. How much monthly income do you want this portfolio to generate eventually? $500, $1,000, $5,000. Define the target.
That gives you something concrete to aim for. Step 2.
Build your watch list. Use the scorecard. Identify those high-quality dividend aristocrats, solid blue chips, maybe some core dividend ETFs that consistently pass the tests. This is your pool of potential investments.
Step 3. Evaluate and prioritize. This isn't a one-time thing. Regularly recheck the contenders on your watch list. Confirm the payout ratio is still safe, under 60% of FCF. And actively look for what Carter calls speed bumps. Speed bumps, like warning signs.
Exactly. Has there been bad news? A sudden change in management? Debt levels creeping up unexpectedly? Fundamentals changing. If a company starts failing the scorecard, you need to reconsider investing in it, or maybe even sell if you already own it.
Diligence is key. Step 4.
Make your investments. Start. Don't wait for the perfect moment because it never comes. Start small if you need to. Automate it. Use DRIPs. Have a plan for how much you'll invest and how often, and stick to it. Removes emotion.
And finally, step 5.
Regularly review your portfolio. This is the calm investor way, not daily checking. Maybe quarterly, maybe twice a year. Check if your company's still past the scorecard. Are their moats intact? Financials healthy? If yes, great, stay the course, maybe add more. If no, then you calmly make adjustments based on your plan, not panic.
It all loops back to that core principle, doesn't it? Consistency beats prediction. Stop trying to guess the market.
You can't predict it anyway. Focus on what you can control. Selecting quality income-producing assets based on proven metrics like cash flow and dividend history, reinvesting consistently, and letting time do the heavy lifting. When the market gets noisy and scary, you look at your plan, check your fundamentals, and stick with it.
That focus on cash flow, on the dividend history, on the scorecard, that's what provides the security, the peace of mind, not just the financial return.
That's the ultimate goal Carter lays out. Financial independence, coupled with genuine peace of mind.
And Michael J. Carter, drawing on his finance background, really managed to translate these complex ideas into something accessible, something doable for regular people just trying to get away from the market stress.
He really did. The book itself feels like a complete toolkit. You get the dividend safety workbook he mentions, those detailed guides for different portfolio sizes, and that clear 12-month plan. It's a practical manual for building that consistent income stream.
It feels like the guide for anyone serious about achieving that financial independence and, just as importantly, that calm he talks about. A really disciplined, understandable approach.
Couldn't agree more. It lays out the path clearly.
So, to get the full details, the workbook, the specific budget strategies, the complete step-by-step roadmap Carter provides for turning dividend investing into a source of reliable income and genuine peace of mind, you really need the full resource. Check out the book in the link below at Amazon.